So as a new month begins, let's see what the markets may deliver. Joining me now from the Frankfurt Stock Exchange is Gunnar Miller, Global Head of Research at Allianz Global Investors. Gunnar, good morning. Thanks for joining us.
Good morning, Mark.
We heard from Barton Biggs there saying there's a 1 in 5 chance of a double-dip recession. You go along with him, don't you? You don't think we're heading towards a double dip. Why is that?
Well, we don't expect a double dip. We're expecting a moderation of growth dynamics. And again, talking specifically about the U.S., the reasons why a new recession isn't our base case is because there are accommodative central bank policies. You have a private sector with cash-rich balance sheets right now, and we're seeing that in M&A, and also the possibility to invest out of strong cash flow. And we are seeing the ongoing structural growth in BRICS, as evidenced by the Chinese growth figures out overnight.
Are those factors, though, enough to drive equity markets onwards and upwards?
Well, they should be. I mean, it was interesting. Before the Chinese data came out yesterday, the concerns over the U.S. and the possibilities of a double dip were a bit of a specter over the market yesterday. So we had a weak day yesterday, and we're seeing strong opens this morning as a result. And we're not believers in complete decoupling, but the view that the U.S. Is the sole driver of European export economies, notably Germany's, is clearly overstated when one sees the demand coming in from the BRICS, specifically China.
Does that mean, Gunnar, that the bond market's wrong? I mean, as we know, record yields all over the place. Does it tell us that bond investors are just far too gloomy?
That might be the case. Specific to Europe, there's an interesting dynamic because you have a big split between the have-lots and have-nots, if you will, of the world, and one ECB. And so you sort of have a barbell situation where the ECB is having to try to set monetary policy, by extension trying to peg where the euro is, as well as trying to determine where bond rates end up, having Germany very strong on the other side and Spain on the other. The latest unemployment statistics out of Germany were bang in line with expectations, 7.6%, down 283,000 year over year, and compare that to Spain, where the unemployment rate is 20.3%.
But then Germany is deemed, as you say, a have-lot, and you like German equities. But what about if the export story wanes? What if the end markets slow down? How's that going to hurt the economy?
Well, that's the big concern, and we did see that yesterday. The leading indicators in both the G7 and the BRIC countries are showing clear signs of what we call rolling over, but after very strong growth in the first quarter of 2010. We think a lot of that was base effect. We are going to see a reduction in policy stimulus, which could give things a little bit of moderation. Also, inventory restocking is probably running its course. But again, we don't expect a double dip, only a moderation in the growth dynamics. And we're seeing China step into the breach where we're seeing weakness in the U.S.
Gunnar, thanks for joining us.